Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. This show, as all our shows, are for informational purposes only concerning Market Chameleon tools and products. If you are searching for investment advice, please reach out to a licensed professional. Take one more look at the disclaimer before I remove it from the stage. And let's now welcome the man of the hour, Dimitri Pargamanik. How you doing, Dimitri?
Good morning. Good morning, Will. How are you?
Great. Some big rips in the market, huh?
Yeah. Good morning, everyone. And we'll take a look at some insights, about looking at yesterday's closing price in the market. And in particular, we're going to talk about the closing price, how it's determined, what kind of insights we could get from that closing price. And I'm going to share my screen here. And what we'll do is navigate to SPY and take a look at yesterday's closing price. Talk about a little bit how that is determined and see what type of insights we could get from looking at the price action and the volume. Okay, so it'll make more sense once we look at an example. I'm going to navigate to SPY. So let's put SPY up in our search box. We come to this summary page, and then let's click on price action on the menu to the left. And on this price action, we get this table that breaks down the trading volume and VWAP prices based on the different trading sessions. I'm going to go to yesterday's action because today we're in a pre-market, but we're looking at the closing price, closing cross. So we could only look at yesterday's. And I'm going to go up here and go to April 9th. And now we have this table, and you see a breakdown: pre-market session, opening cross, regular hours. So this is after the market's open, there's continuous trading. And then at the end of the day, we have this closing cross auction. And before we go into the analysis of yesterday's closing cross and what type of insight we could get from it, first, let's just explain what that is, the closing cross, how it's different from regular trading hours, and who might be trading on that particular closing cross auction. All right. So when we talk about regular trading hours over here, I'm going to expand it. Regular trading hours are when the market's officially open. So there's a pre-market trading, but in pre-market trading, we're not in official trading hours where we have everybody who can trade, start entering orders. Like you have institutions and certain traders that aren't allowed to trade outside hours and so forth. Everybody could trade their VWAP orders. So regular trading hours are, defined once the specialist opens up the particular stock for trading. There's continuous trading. You have special rules, Reg NMS rules in place. The order book is live. The VWAP orders are live. And that's typically from 9:30 to 4 o'clock. Okay. When the markets close, okay, and you can see here, these are the trading hours, and we broke it down like the first hour of trading, midday, last hour of trading, and then these last 2 minutes. When the market closes, it's based on a single price auction. Okay. And what that means is that a specialist in the stock will accumulate throughout the day orders that want to get executed on the closing price. It could be market orders, it could be limit orders from the buyers and the sellers. Okay, those will not get executed when it's a special order type. It's not going to trade at 2 o'clock, 2:30. You could enter it in at 2 o'clock, but it won't trade at 2 o'clock. It won't trade at 2:30. It won't trade at 3:30. It won't trade at 3:59 and 30 seconds. It trades on the closing price auction only. Okay, so what you're doing is entering an order that needs the specific closing price. Okay, you don't want to. It's not going to get executed during regular trading hours. Even 1 second before. So what that order is you're going into a separate auction, right? You're going into a auction where the specialist accumulates the buy orders and sell orders, matches them up, and said that's the closing price. Okay, so you either bought or sold on the closing price, and those are important for certain institutions and trading strategies. Okay, so and when we think about like a mutual fund, they calculate their net asset values based on closing prices. Their net asset values aren't based off like the price at 350 and at 4, after hours at 4:20 or at 10 a.m. Net asset values based off closing price, and certain strategies are also going to be based off closing price. Those are the benchmarks. Okay. And it's important to understand that, because what we're doing is filtering out and saying all the other players are not in there, right? So you don't have retail customers who need the closing price. You can buy your stock whenever you want during the trading hour, regular trading hours. You want to buy a stock at 2 o'clock, you can buy it at 2 o'clock. You want to buy at a certain price, you put in a limit order, and it will get, if it gets there, it gets there. Closing price is different. So you could have market on the close or limit order on the close. And so given that, right, we could filter out and we could say, okay, based on the price action and based on the volume, what do we think is happening? Because we know most likely what type of trader is entering those orders. Okay. Another thing to understand is how a large imbalance will work. On a closing price, if there's more buy orders, right? Let's say you accumulated and you have 1 million shares to buy of one stock and 500,000 shares to sell. So you got this buy imbalance, all right? If you have exactly 1 million shares to buy, 1 million shares to sell, then you could find that price, then it's good. The specialist is going to try to get it right around where the closing price is. Okay, so the specialist will probably fill it. Let's look at the trading hours yesterday for SPY. So you can see here in SPY, at 4 o'clock. This is the last minute of trading before that closing price. The VWAP price was $543.31. That's where the stock was trading regular hours right before the close. But why did it close at 548.62? That's a big difference. Look, this is where the price was trading, $543.31. But it closes $5 higher, right? More than $5 higher than where this was trading. So that's a big uptick, right? You're talking about a really big, you're not talking about 2 cents higher, 3 cents higher, 10 cents higher, $5 higher. That's a big uptick from where the stock was trading. You could even see the last 3 minutes, 543.67, 544, 543. We didn't get that high, right? 548. But it did close at 548.62. And if we wanted to, I'm going to just show you on the volume, hit closing cross. You could see yesterday's volume. These are all the closing price, the volume going back in history. So yesterday's closing volume was big, 8 million shares at the close. So you could see the history of it. It's very big. And on a big uptick. Okay, so let's come back here for a second. Let's go back to the summary. So what do we think could have happened? Well, it could have been that there's large buy on close imbalance from institutions. So that's because they're creating units like from mutual funds. It also could be from strategies that need to balance their portfolios, their risk at end of day. Okay, it's very common that there are strategies, even like let's say option strategies that have deltas. You have negative gamma, let's say. You need to balance and go out delta neutral, right? Your strategy, your risk management, your firm needs to go out basically delta neutral and reduce that risk. Okay. So, or it could be a combination of both. All right. Now I'm going to look for clues. Was it like a lot of retail customers just entering orders yesterday to buy mutual funds, for example, right? So we should see a lot of market on close buying balances there. So let's just take a look at that. I'm going to go over here, stocks, and we're going to hit stock order imbalance. So these are large market on close. And we could see here on April 9th here, this is yesterday, we had a total of buy order imbalances of 615 million versus sell 986 million. So those are typically coming from, an accumulation throughout the day where units need to be created or redeemed. So it's not coming from there because we don't see this, big imbalance, of, like 3 billion to buy and 100 million to sell. Then we would kind of have a clue like that's maybe where it's coming from. So it wasn't coming in these individual stocks that they're creating units. So the other then inference we could make is that there was a big demand to rebalance a risk at the end of the day, right? Because they could have waited, anybody could just buy in the middle, but at the end of the day, there was a big imbalance and they needed to own or buy, covering a short delta, for example. And the way the specialist works is if you have an imbalance, a specialist cannot sell on a downtick, cannot buy on an uptick. So a specialist only steps in when there's an imbalance to one side and they supply liquidity on the side of the imbalance. So if they're supplying liquidity on the side where there's more buyers, they're on the sell side. And if they're on the sell side, they're selling on an uptick. If there's a demand to sell, right? There's a lot of sellers, not enough buyers. The liquidity provider steps in, specialist market maker steps in, provides the liquidity on the buy side, right? They need to provide liquidity on the side of the imbalance. But for them to provide it, they provide it on the downtick, right? They can't provide liquidity on an uptick, right? They provide it on the downtick. So based on this big uptick, right? What inference can we make? That's the question. So what inference can we make from yesterday's price action? Let's go back. This is yesterday's. We're going to look at regular trading hours. This is the last 2 minutes. The VWAP traded at $543.90, $3.6 billion worth of stock. But the closing cross was $548.62. So nothing even traded in between it. That was the last regular trading hours. And then we see this big jump on $4.5 billion worth of stock, 3.3 times higher than usual. So the inference there is that there's a need or demand to hedge that risk. And we saw that yesterday, the market was up 10.5%. So if it's 10.5%, the market's running up, you're buying it at the high, you'd have to get, if you're covering that risk, right? If that's the idea, if you're covering that risk, it could be coming from that negative gamma, right? That there's positions out there with negative gamma that, because if you're negative gamma, negative short options, you're covering that delta as the stock moves violently in one direction. Then you're covering the delta to the upside. If it moves down, you're covering the delta to the downside. So the inference there is that there could potentially be a really serious negative gamma position or cumulative positions out there that were needed to reduce that delta risk, reduce that directional risk, because as stock runs up, you're getting shorter and shorter. The stock, you cover your delta. If stock runs down, you're getting longer and longer delta risk. So one of the insights, and this is just it's an inference, but it's a way of looking at the data and trying to explain, like, there's a big anomaly here. There's something really big, unusual that happened. The market doesn't go up. What is that? 1% on one tick. Right? Like, think about it. So one tick, that's it. You had a price here, and then one tick goes up 1%. That's very highly unusual for that to happen. Like, even when I looked at it, I don't even remember the last time I've seen that. So it's a very big uptick on large volume at the end of the day, the closing price. And the specialists, right? The specialists, it looks like the market makers, liquidity providers had to, because of that uptick, were on the side of providing supply. They needed to sell in order to provide liquidity on that uptick. So that's kind of the key insight and a way to look at the trading activity, trading volume, and if you understand the differences between market sessions and what type of players and orders are active in those sessions, you could get some key insights into the actual trading volume and activity. And again, this is an inference, but it's an inference based on the data and information that we have available. So I think I'm going to stop there because, it was a good example to cover that type of market session trading.
That was awesome, D. Great job. Great insight. Some people were mentioning the start of earnings season tomorrow. Maybe that's something we can look at. I think the banks start reporting tomorrow. Obviously, everything in the news going forward is probably going to take on a different meaning now. There's so much volatility in the market. Awesome job as always, D. Thanks everyone for joining. Remember to like us, follow us, give us a thumbs up on YouTube. Again, great job as always, D. Thanks so much, buddy.
Thanks. Well, bye everyone. Stay safe out there. Have a great trading day, and we hope to see you tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye-bye.